Hi, everyone. Thank you for joining us today. I'm Marche, the webinar director here at Advice Chaser. Before we introduce our guests and get started, I do need to do a bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial financial professional. So we're thrilled to bring you this educational presentation today. Attendees are muted, but we do encourage you to ask questions using the chat box. And our presenter has asked that we take care of those queries after the webinar today as appropriate. And if you ask a question in the chat box, go ahead and leave your phone number as well. If we can't get to your question during the presentation today, we'll make sure someone reaches out to you after today's event. We want this experience to be as educational as possible, so please don't hesitate to ask for clarification or expansion of the material. Well, I'd love to introduce you to today's moderator, and I'll get his picture up here. Andrew Jensen is a senior wealth advisor, director of alternative investments, and investment committee member at Zermatt Wealth Partners in San Diego, California. Andrew operates as a fiduciary and takes a top-down approach when formulating a client's long-term wealth strategy. Andrew augments his wealth management process by working carefully with vetted estate planning, accounting, investment banking, and insurance experts to harmonize each client's entire financial plan picture while mitigating risks, which could derail a client's objectives. Andrew, why don't you go ahead and come off of mute and say hello?
Hi, everyone. Thank you so much for joining us today. It's a pleasure to be speaking to you along with Kirk Mitchie. Our firm's Zermatt Wealth Partners. To give a little background, we've been around since 1982. One of the kind of the pioneers in the fee-based advice side of the business versus brokerage in terms of investments. We consider ourselves a comprehensive wealth management firm who happens to have a specialization in closely held business owners as one of our core specializations. What comprehensive wealth management means is we do detailed financial planning at the onset of a relationship with the client that informs our customized portfolio construction. And then we definitely help a lot with pre-sale with business owners in terms of optimizing their tax situation, managing their 401ks, and ultimately preparing them for that sale. And along with that, we introduce highly vetted, specialized network of experts in tax planning, lawyers, estate planning attorneys, CPAs, and investment bankers. But in the case of today, it's very important to work with what I would consider to be a pre-exit consideration consultant that can sit on the same side of the table with an entrepreneur like our firm does, where they have a lot of transactional expertise. The experts that we bring into an equation when we work with a family or an entrepreneur want to make sure they provide good ROI to our clients. That's our main concern, and that they have the expertise that we're seeking. So I'm happy today to be moderating a presentation with Kirk Mitchie. I've known Kirk for over 10 years. He's the founder and operator of Candor Advisors. Kirk has a very broad specialization coming from investments, wealth management, and he has a lot of transactional expertise as it relates to sort of once someone thinks about selling that business, how do we optimize that sale? What are the options? And then what are all the really important details you have to pay attention to throughout that transaction? So I'm happy to introduce Kirk.
And Kirk, if you don't mind, I'll just go ahead and read a little bit about your credentials here. Kirk Mitchie is the managing partner of Candor Advisors, like Andrew said, and Candor Advisors is consultants to founder-led businesses contemplating capital events and value enhancement. All founders eventually need to transfer ownership or control of their successful businesses. Candor Advisors ensures entrepreneurs optimize those outcomes, minimize taxes, and achieves their objectives for sustainability, liquidity, and legacy. Kirk's areas of expertise include transaction advisory services, mergers and acquisitions, with emphasis on founder-owned businesses, corporate and family office governance, capital raising, private equity, corporate strategy, and succession planning. His combination of investment and business experience inform his ability to help entrepreneurs navigate complex entity, family, and legacy decisions. And Kirk, I want to say thank you so much for being with us again. We're excited to have you present, and I'm going to turn the time over to you.
Thanks, Marche, and thanks, Andrew. Welcome, everyone. Thanks for being here. The overview given about Candor Advisors is plenty sufficient. Suffice to say that if you're a founder or business owner contemplating a change of ownership or control, thinking about retirement, thinking about buying out a partner, whatever the capital issue might be, you don't know who to call first or even next for that matter, navigate over to www.candor-advisors.com. Got a lot of great content on the site, and then if it makes sense, reach out to us directly. What we talked about in terms of putting together a little bit of a follow-up to a prior event we did, which is, we talked about, selling to an outside buyer and some of the considerations that, founders needed to go through or might want to go through to optimize those outcomes. And some of the questions at the end of that presentation led us to the idea that there are a lot of different paths. It's not just a function of, picking the traditional, kind of prepare your company for sale, find an investment banker or business broker, get the right wealth advisor to coach you on how much money you really need to get the right M&A attorney to make sure that the structure is right and you don't sign the LOI too soon, and then get through due diligence and get the proceeds at the other end of it. That's one way to do it, but there are a lot of alternative paths to that exit. So look, the traditional paths are, generally speaking, and especially now because there's so much M&A activity, that you're either going to be contacted by a potential buyer, an investment banker. They're going to want to take you to market, and they're going to want to sell you to a strategic buyer, a company that's in your same business, maybe even one of your competitors, or a financial buyer, a private equity firm, a structured equity firm, a mezzanine finance firm, or some combination of those. And generally speaking, most founders envision selling, getting all the cash at the close of escrow, and then riding off into the sunset after making sure the new buyer has the keys and the awareness of where the cleaning supplies are, right? Most transactions don't happen that way, but that's how most people kind of think it's going to happen. What's more common is that a majority stake is sold to a financial buyer, and a founder continues to be involved at some level and plays for what's often referred to as the second bite of the apple. And those are the kinds of transactions that get the most focus. But today, we're going to talk about a few other paths that are either your options or your fallback positions. So go ahead and advance one more, Marche. So the first one usually takes some outside financing. But if you've got a mature company and a management team that's been involved with you for a long time, and you've paid them well, but you certainly haven't paid them well enough to actually buy you out, there are a lot of financing sources that will back existing management to buy out, the majority or a minority stake by the founder. And you as a founder can either move into kind of a clipping coupons role in your business. You're kind of passive, you're around as needed, but you're no longer running the business. So you're able to do some of the things you want to do, maybe travel more, maybe spend more time with the grandkids, play more golf, whatever it is. But you've got your management team to kind of continue your legacy and pay you out of the money that your company continues to make for your business over time. right? So it's usually a combination of some money up front that comes from an outside source, and then some distributions to you over time. But if you've got a few key people in place and they have the willingness, and together you kind of have the creativity and the wherewithal, management buyout can be a great alternative. Why don't we go to the next one, Marcia? So this one is an employee stock ownership plan, or an ESOP. These, ESOPs get talked about a lot more often than they get done, and frankly, they're a wonderful way to control legacy of the business and to ensure that employees who might matter greatly to you as a founder get taken care of. Now, oftentimes an ESOP transaction is done at a lower level than an outside buyer might pay for the company, and there are some reasons for that that we can dig into in the Q&A. But there's also some tax benefits to selling to your employees. So in many ways, if you've got, some founders talk about their employees or their culture as being like a family. Well, if you want to translate that into how you then kind of retire and monetize and get liquidity from the business you built, then together with an ESOP consultant, a financing source, the right lawyer, and the valuation people, there's a way to create a strategy that might get you to take some of those chips off the table, like a management buyout or an outside buyer, but keep all your employees in place, not overburden the business with commitments to pay on debt, but also allow you to then earn the money that buys you out over time or keeps you involved for a long, long period of time. And there are a lot of project-based businesses like construction companies, pool cleaning businesses, and some much more complex and large businesses that go through an ESOP process, because it might just be the optimal outcome if you're looking for kind of getting the right amount of money after tax and also then preserving that legacy. Let's move on to the next one, Marcia. So I kind of touched on this a little bit, because either of the two prior strategies will allow you to sell a minority or majority stake in your business and continue to take some level of distributions and continue to be kind of a consultant to, or sort of, a chairman emeritus to your business. But the other way to do this is to think about, especially in a smaller business, like a professional services business, or a company where your relationship with a lot of your employees, with a lot of your customers, is vital to the ongoing kind of recurring revenue or the returning revenue to your business. Then developing a successor. If you have someone already inside the company that's kind of your right-hand person, then one of the best ways to kind of maintain the trajectory of the business and kind of keep everybody's job intact, and yet still kind of take some of your own chips off the table, develop that successor, pay them enough, incentivize them with equity, mentor them, make hard choices if you need to. If the person you get on that path isn't capable of doing it, you got to make that hard decision too. But, look to transition not who you are, but what you do to another person so that the business can continue. And then in a lot of ways, you've kind of created a chunk of your own bond portfolio. You're just getting regular distributions from the business. You're no longer kind of having to work day to day. You're not having to respond to, aggravated or worried, client or customer phone calls at, off hours. But you still stay involved enough in the business to make sure the trajectory continues, the value is there. And maybe someday down the road, when that complete transformation, the movement to your successor has happened, maybe there's a sale down the road, or maybe that just continues to be part of your family's estate plan. And, the money keeps flowing to you and then your family eventually. Go ahead and move forward, Marcia. Okay, so I've used this term at least 4 times that I can count. Take chips off the table. And I'd be the first one to tell you that I don't like in investments and corporate finance to use gambling analogies or metaphors. And yet, I think calling a transaction de-risking sounds really pretentious. So I'll stick with the take chips off the table. So look, what we're talking about here when financial professionals talk about taking chips off the table, just essentially saying, look, let's say that your business is worth $20 million. And let's say that there's no one who's going to come along and pay you $20 million all in cash to allow you to just kind of ride off into the sunset or spend the rest of your life on the beach. Well, maybe there's someone who will pay you 8 or 12, right? Those are the chips you're taking off the table. And then you retain the balance in equity in the business. Maybe it's got some specific, preferred dividend to it, or maybe it has some kind of other structure to it. But you take some of the value of your business now, and you're doing it, one, to reduce your own risk that the business will continue, or that you'll go through recessions and have diminished value and then have to build it back up. So you're getting some of the value of your business now, but maybe what happens is that if you don't do an outright sale now, especially if there's still growth opportunities ahead for your business, and you've got a capable management team and capable employees to kind of push things forward, and you find the right financial buyer who's going to give you the money to kind of take those chips off the table, and they can then add their capital, their strategic guidance, their operating expertise, then maybe the second check, even if you thought you sold the majority of the business the first time around when you took those chips off the table, maybe the second check is even bigger, because that financial partner and a re-energized business can grow to a bigger number. You can stay involved enough to make sure that the legacy is preserved and that all the kind of tech transfer goes out of your head and to the next people and onto paper and into standard operating procedures. But then maybe the business could be even more valuable down the road. So this might take care of your family, fund your next adventure, maybe not endow the rest of your life completely, but certainly reduce the risk, pay off the homes, cover all the education, maybe buy the second home. If you haven't already had enough pain in your life, take up golf or buy a boat. You'll eventually give up golf or keep working at it until it kills you. You'll eventually sell the boat, I promise you. But look, this is a way that you need to sort of think about this closely held asset that you have as an asset. And it may not be tradable like a public company in the stock market, but there are lots of capital sources out there that are willing to get creative and collaborative with you to do that. Let's go ahead and move forward. Okay. So look, if you're picking up on the idea that these things kind of blend together and that they're not all, kind of bright line differentiations, that's the idea. The alternative path to a traditional sale, to the extent that there is such a thing as a traditional sale anymore, is the idea that there is right now somewhere, industry estimates are that there is about $1.5 trillion available in what's called dry powder, committed but uninvested capital held by financial sponsors, people that could potentially buy your business and put some of that dry powder in your pocket. There is also another $500 billion in what's called SPACs, or special purpose acquisition companies. Now, so you've got $2 trillion out there looking for businesses like yours. It's held by firms that are often called private equity firms, structured equity firms. But then there's also all your competitors and the larger firms that do what you do or encompass what you do. They're all looking to grow by inorganic means, acquisition, and organic means, gathering market share, right? So the thing to do to take advantage of this moment, which also has, kind of economic uplift happening as a recovery from the pandemic ensues, and you're seeing in the latest inflation numbers that we're doing really, really well right now, right? So there's lots of demand for businesses that are really healthy and good. There's cheap capital available to invest in them. And if you're within what you think is maybe 2 or 3 years of selling, this is the time to start looking at these possibilities, because maybe you'll be able to partially cash out. Maybe you'll be able to find the right, kind of combination of these strategies to get you to be able to keep taking distributions and yet take some of those chips off the table. And maybe the legacy of your business gets preserved in a way that you'd want to if you kept hanging around by starting early with a succession plan. And I don't just mean the external succession plan of you leaving the business, but the internal succession plan of how the business survives and thrives without you. Let's move forward. There we go. So here's another one that people kind of struggle with this one, but I will tell you that if you've got a business, especially if it's you have a co-founder or co-founders, and you've started to get more wealthy, more successful, nobody is worrying anymore about whether they're going to make ends meet. But the way that you and your partners and co-founder see the business going forward, or stages you are in your life, one wants to work more and grow and reinvest more in the business. The other one wants to start taking bigger distributions and work in, kind of half weeks. Some of these things can bubble up into conflicts that will ultimately cause the business to need to get sold, and probably at a discount, because there will be dissension. Before those things happen, and maybe to preserve the legacy of, kind of a middle market business, something that's worth between, say, 25 and $200 million, that could maybe be a much, much larger business, is the idea of putting in an advisory board, even before you have financial partners. Any financial buyer will put an advisory board in place, usually with one or two of their people, one or two of your people, and one kind of outside director. That outside director will be one of their people, right? So you might as well just start to think about this early. And don't just recruit your pals. Recruit people who can ask tougher questions, who are supportive of the business, but who have the kind of experience that, certainly you could pay these people a little bit to be involved in your advisory board, but you get a multiplier effect on their experience. If you're in something like YPO or Vistage, and there are people in your group who used to be in your group, who've sold their company or are no longer participating, those are the most natural people to get involved, because those people can help you to navigate through difficult decisions, right? Don't put your lawyer on your advisory board. That puts them in a tricky position down the road. Your financial advisor or wealth manager could be a good person to put on your advisory board, because they have yours and your family's kind of best interests and different perspective than yours. Start to think about that being a way to kind of professionalize your business, because the more things you do like that, the developing a successor, the having an advisory board, the creating standard operating procedures, systematizing the things about your business, all these things will get a buyer, or this kind of alternative paths to a traditional buyer. All of these things make your business more sustainable and more valuable. The core business of what you do isn't changing, but the likelihood that it can continue is changing. And all businesses sell, regardless of transaction, as a multiple of their economics, discounted by the likelihood those economics won't continue, or increased by the likelihood that those economics will sustain and grow, right? So just sort of think about this as being a nice extra step to maybe get together quarterly with some people to kind of review some things and inflection point decisions, and get some great outside input. All right, well, I'm not completely talked out, but
That's okay.
I will happily cede the floor.
Well, I'm going to go ahead. I know we've gathered some questions here. I'm going to send those along to Andrew just a second here.
Kirk, while we're awaiting the questions, you had mentioned, and I agree, I don't see it as often as you might think. Why do you think ESOPs are not taken advantage of, given that they do provide significant flexibility and tax benefit to the primary owner early on compared to these other strategies? Why do you think more people don't go down that path?
It's a fantastic question, because I think there is a complexity element, and then I think there's a behavioral element. So the complexity element is that for an ESOP to work, first you need an ESOP consultant to come in and look at the business, and they will probably bring in a valuation expert, because there is an element of, you can't just decide what you're going to sell your business to your employees for. There's a fiduciary element that happens when an ESOP, which is a trust, gets created. An evaluation firm has to opine on the value of that, right? And so there's both complexity and then other steps. The ESOP usually requires outside financing. There are a lot of banks that are really, really active in this area, but a lot of business owners aren't aware they're there. Usually the kind of the commercial bankers that are out there working with their customers on, asset-based lines of credit and other kinds of credit products only bring up ESOPs as a reactive thing, right? So they don't really talk to their customers very much about the idea that, listen, maybe in an outside sale to an outside buyer where you can't preserve your employees and you don't know what's going to happen to the business, and you might get some odd structure where you get 20 million evaluation, but you get 10 of it up front and a bunch of contingent payments, and you don't know what's going to happen. And maybe in an ESOP, you're only going to get 15 million because that's the, kind of ESOP valuation. But for the 20 million with all the structure, that's fully taxable, right? And you're going to pay capital gains on everything over basis on that. Whereas the 15 million ESOP, if handled the right way, might be almost or fully tax exempt if you structure it the right way,
Yep.
right? So your net after tax might be better, but there is that complexity, there is that cost. And the behavioral piece I'll just throw in is that, there's a pride thing in saying that you sold your business for 20 million bucks to a private equity firm or $40 million to a competitor, and you got all that money up front, so that piece, I wouldn't discount that piece. It's there. It's a great question.
Yeah, ESOPs can be pretty powerful tax mitigation strategies for anyone that's not really fully aware of them from a wealth perspective. And I would say one of the areas that I see with some of clients and prospects and entrepreneurs that I deal with is maybe failing to structure some sort of retention system for a key person or key people, and then a whiff of a sale comes about or recap, and they lose those people, and then there's a retrade. So I think you don't have to do that necessarily with company stock. There's a lot of different ways to do it. There's ways to do it with insurance and benefits. And I think it's key to think through and strategize around and do that early, because that helps you think about maybe an ESOP is the right way to go. Maybe developing talent is something that could ultimately maximize the value of the business down the road, whichever route you go.
Yeah. And in fact, real quick, just to add to that, a sale to an ESOP does not preclude a sale to an outside buyer down the road. What can happen is, the founder can sell, say, a minority stake to an ESOP, and then things get frothy. I'm involved in a process like this right now, where there's a lot of attention, a lot of excitement about this particular business. And we brought in an ESOP consultant evaluation firm to find the right price for the founder to buy out the ESOP at fair market value and then sell the entire business, right? So this will, even though as a seller, you can't always protect your employees, in this case, whether the new buyer is going to retain the employees or not, all the employees are going to get all the money that they made from the time when the part of the business was sold to the ESOP to now the fair market value that's higher. And there's still going to be an outside buyer. It looks like private equity firm, but there are some firms that like to buy ESOP owned businesses. So it doesn't preclude, that second bite of the apple. It's just a different structure.
Let's see, another good question. How do founders avoid getting taken advantage of in the transfer of their business ownership, which I know you know this extremely well through and through?
Yeah, look, there is, I mean, not for nothing, there's a video on my website called Full-Time Predators and Part-Time Prey. Look, if you're selling your business, no matter how savvy you are, if you haven't been through a lot of transactional, if you don't have a lot of transactional experience, you really need to bring people in. I'm not saying that if you've already identified your buyer and you think they're the right buyer, that you can go without having an investment banker or business broker. I would strongly caution anybody to do a deal without the right M&A counsel involved. And I would further say never, ever, ever sign a letter of intent without getting prior guidance from transactional professionals, because it only gets worse after you sign the LOI. And that's where you're likely to take advantage of. And where you get taken advantage of is not understanding the terms and structure. And structure is what financial people in the M&A world call everything except cash. So you will hear people talking about, well, I'll give you, I think your business is exceptionally valuable and I'm going to pay you $20 million for it. And then when you see the letter of intent, it shows that they're going to give you $4 million in cash up front. They want you to carry back a note for $4 million. And then they want to pay you $12 million over the next 4 years based on an earnout of increasing EBITDA, which you'll no longer control because you're not in charge of the business, right? So you got $4 million up front for a $20 million business. And I'm giving you a kind of an extreme and almost absurd example. The business starts to trend down because of some things they do and you can no longer control. And so now your note is imperiled because you can't really foreclose on the business you just sold to collect on your note because there's not enough cash available. And the earnout payments, you're now not going to get them because the business isn't growing anymore, right? So you sold your $20 million business for $4 million and it was all perfectly legal. And you can go to your Vistage group and to the country club that you're going to eventually have to not be a member of anymore because you didn't get enough money to stay. And you can bitch all you want to, everybody about what awful people these financial buyers are. But listen, this was all disclosed, and all you had to do was pay somebody a couple $1,000s to read this letter of intent, have them redline it. And they could have put more money in your pocket. They could have protected you from doing the transaction. They could have chased away a non-serious buyer. But people don't do it. And part of it is behavioral and part of it is just a lack of experience. It's common though. It's unfortunately very, very common, even among what I would call founder-friendly private equity firms.
I think that's where an expert like you really adds a lot of the value is what resources are absolutely vital. Where do you spend that money in that transaction process? The spend compared to the potential sale is often, a lot smaller than the potential opportunity. So it's very important to understand, what type of transactional attorney is required, what level of investment banking team is required, national, regional, so on and so forth. So I think there's a lot there. And a lot of the structural stuff, this next question on the tax side can work, but basically for a $5 million level valuation business, do a lot of these strategies work from your perspective, Kirk? And then to dovetail further onto that, especially if it's a lifestyle business or let's see here, and can you do that? How do you do that succession planning if it's a lifestyle business? So kind of two questions that are a little bit together.
Yeah, so I would say that that's a tricky one to answer without more specific information about the business and what the founder objectives are. But I'll kind of hang a little bit of a framework for how to think about it. So the first thing I think that founder does is turn back around to their wealth advisor. And when I finish a couple of comments, I'd love to hear from you about kind of how you might plan and model this out. But turn around to your wealth advisor and work with them to figure out how much you need and how much you're likely to earn, on a net after tax basis, right? To be able to replace the cash flows that you've been getting from your lifestyle business, right? Because this now means that your Model S Tesla is no longer an expense of the company, but you have to handle those payments, right? So, where that would be added back to the EBITDA when you're doing a sale and you're being paid a multiple of that, it's just now money that comes directly out of your pocket when you're structuring a small transaction. And there are some clever ways that people can, bifurcate the intellectual property of their business and kind of the other assets of their business to, kind of get the goodwill into a tax exempt or tax deferred structure, on a transaction like that to preserve some of that value. There aren't that many tax planning things you can do 90 days before an outright sale of a $5 million business. You got to spend 183 plus days in another state to avoid state taxes. And I can tell you, for California's sake, the Franchise Tax Board is going to look at your bank statements and your ATM usage to prove whether you were or were not in Austin for 183 days. So beware of that. There's no sneaking around that. They're very, very aggressive on that. But there are some other planning techniques that have less to do with investment bankers and M&A attorneys and more to do with, kind of wealth advisors and tax attorneys and, not so much estate planning attorneys, but then even, some of the life insurance professionals out there can structure some stuff like that. I'd love to hear your comments on, kind of how somebody thinks about whether that transaction is going to be enough to replace the cash flow.
Sure. I think for us, it really comes down the root of everything, which is comprehensive financial and wealth planning. So doing a detailed analysis of what are my resources? What is the expected return rate on any net proceeds from a sale? Really looking at having an honest conversation of, or recap, what's the actual net of taxes result that you're going to achieve from that transaction. A lot of people overestimate those things. And they overestimate in their financial planning mind, probably the rate of return that's realistic in a very low interest rate environment. So those are two of the things. You got to map that out and really help the entrepreneur, the business owner, get to their numbers. So what's kind of that minimum net of taxes situation with some conservative financial planning and looking at things like inflation over time, really mapping out those cash flows over the rest of a potential client's life. That's where you get to the root of the number. Beyond that, in terms of lifestyle business, I think people would be surprised the varied number of strategic buyers that are out there at lower and lower levels of sale transactions. So whether it's healthcare or whatever it is, you'd be surprised. There are private equity backed strategic acquirers of dermatology businesses. There are strategic buyers of commercial insurance businesses. So there is a lot of capital out there, and there's a lot of specialization. So working with your financial advisor and someone like Kirk, ultimately you can potentially source some of those exits, so to speak.
Yeah, I saw in the Q&A that somebody asked about healthcare niche, and you just mentioned it too. I'll tell you that look, this is a great time to be thinking about selling almost any business. There's a couple of reasons. If you talk to, so first of all, the difference between hiring like a transaction advisory professional like me or talking to an M&A attorney is that, and say an investment banker, is that an investment banker, a really good investment banker, doesn't just assess what's the universe of buyers that are out there, financial and strategic, and how do we position your company, and how do we make sure that we protect against the risk factors or things that will hurt valuation, and how do we reasonably build a forecast so that you can kind of skate into the sale process with tailwind. But most importantly, that investment banker creates competitive tension, right? So they source enough different kinds of buyers so that by a deadline specific, they get indications of interest. And whether they get 3 indications of interest or 12 indications of interest, their job is to go back to those potential buyers and guide them to the idea that they are firmly in third place, and that, you know, if you really want to be in the hunt, this is going to be at least an 8 times EBITDA kind of deal. If you can't see yourself getting there, probably not worth you having management meetings with the company. Now, sometimes that's sometimes that's factual, and other times that's just what it takes to get somebody to kind of bid against themselves and crank up the number. But I've never been to a closing dinner where somebody, I mean, everybody kind of shakes their head about how much money they pay the investment banker, but it's pretty good alignment with the founder. They make more if they sell your company for more. And if it's structured the right way by the M&A attorney, so that they get paid when you get paid. They don't get paid on contingent payments that you haven't yet earned, but they get paid when you get paid, right? So if they do all those things, you might shake your head over how much they get paid, but you won't regret that you hired them to create that competitive tension. And the benefit of doing it right now, especially if you're talking to in healthcare and life sciences, or specialized investment bankers, don't hire a generalist to do a healthcare deal. It's a bad idea, right? Because there are healthcare investment bankers out there that are medical doctors, right? I mean, you need that extra layer. If you're selling a $20 million manufacturing business, you do not need a specialist, right? But all good investment bankers are busy right now. So you can get a free valuation of your business just by interviewing a couple of investment banks. Part of what they'll do to prepare for the meeting is to have their analysts do valuation work on your company. You'll sign a non-disclosure agreement, you'll send them over a QuickBooks download, and they'll give you a reasonable valuation of what your company might sell for. And they won't try and get you to engage with them to sell your company, assuming they're a good investment bank. If they don't think it can get sold because they're busy and they can't take on the assignment, if they don't think there's a really, really good chance that they're going to get a success fee. And investment banks all play for success fees. They don't get enough money in their retainers to really cover their costs. They need to play for success fees. So if you can get a great investment bank to take your deal, then it's worth kind of heading out to market if it meets your objectives, right? And you're going to get a lot of good advice and counsel, even if you don't go forward with the process.
Let's see here. There's a couple more I think I missed. How are we on time, Marche?
We're doing great. Why don't we go ahead and cover the questions we've got here?
Awesome. Okay, so what are some of the biggest mistakes founders make in selling their business? Which is a great question that very briefly.
Yeah, it's a great question. Look, so I would say the first one is that I talked a little bit before about the fact that the market decides what your company's worth. It's going to pay you a multiple of your economics. It's going to be frustratingly free of what you think your business should be worth, because the market doesn't really care what you think your business is worth. There are enough precedent transactions out there in the marketplace to find companies that are substantially similar to yours that have traded within the last 18 months for us to have relevant data on what the business might be worth. You'll be able to differentiate a little bit in the sale process, but the reality is, if you're a founder who argues with your advisors about what your business is worth, you're wasting your time. The advisors who give you the guidance, who are incentivized to get you a higher number for the business, are not the problem, right? So the seller expectations around value versus market realities of value, that's the number one problem, right? You can't get to a good outcome if you're not going to acknowledge the market's reality. You can decide not to sell, that's your option, but don't argue with the market. It's a waste of time, right? A couple of the others are not being fully forthcoming with your advisors about things that are going to get uncovered in due diligence. Because believe me, no matter how clever you think you are and your CFO is, the junior analyst on the private equity firm that's going to be doing due diligence has worked on 30 transactions in the last 12 months. He's so much more sophisticated than you. He's half your age. He may or may not have just recently earned an MBA, but they'll uncover everything. So, there's a, kind of for those who've read the Four Agreements by Ruiz, I mean, sort of think about the Four Agreements as they relate to due diligence, right? Be impeccable in your word. Don't take it personally, right? Those are the two key ones, right? Due diligence is invasive and it feels accusatory. Roll with it. Lean on your advisors. Ask your investment banker or your M&A attorney whether these questions are fair game, and disclose, hey, listen, a year ago we had a competitor that thought that our IP looked a lot like their IP, and they sent a letter from their lawyer, and that thing seems like it went away a year ago, but we never had closure on that. Disclose that. Make sure that your investment banker and your lawyer knows about that, because if they get caught in the middle of due diligence with one of those things, it'll be hard to recover. It won't be oh shoot, sorry, we meant to mention that, right? Things like, look, if you're a small business and you do your books on cash and not accrual, that's common. No, everyone expects that. If you run vacations through your business, if you put your car payment in your business, those are common. Don't worry about disclosing those things. Those are all really, really common things, right? So, and then I would say the last piece is, kind of a two-part. One, hire advisors. Not saying you need to hire, the biggest Wall Street law firm to handle your M&A deal, but you do need an M&A attorney. Do not hire your real estate attorney to sell your business. Do not hire your estate planning lawyer to sell your business. Don't hire a generalist corporate attorney to sell your business. They might be able to do the documents, but they won't have the reps in the M&A gym to spot the things that are going to be problematic, and they won't be able to kind of put things in the agreement that help you. And the other thing is, once you've hired advisors, whether it be M&A counsel, investment banks, transaction advisory professionals, listen to them, right? There are founders for whom advice bounces off, and they are pretty much always the ones that end up with a bad outcome. They'll blame their advisors, and that's fine. I'm in this, business. I'm sure I have former clients who were frustrated with me and they blame their deal not working well on me. That's fine. The problem, however, is that transactional professionals use their experience and their expertise to try and guide founders to what the realities are and ways to protect themselves and ways to maximize value. And the founders who don't agree or fight that process are usually the ones that have the bad outcomes. And, for all of us advisors, the best of us and the worst of us, we can have influence, but we don't have control. It's ultimately up to the founder to execute. Last little bit, I know I've gone on for a bit, is when you're going into due diligence, make sure that you've got the right resource to handle due diligence requests, because some buyers are going to assess how professionally run your company is by how long it takes you to get back to them on due diligence requests. If you tell them that you're a good delegator and that you give yourself the title of CEO and you've got a crack chief financial officer, and yet they have to wait 2 weeks and keep reminding you on every due diligence request, and everything seems to be coming from your email address and none of it's uploaded into the data room by anybody other than you, then they know your business is not professionally run. And that's going to give them pause about buying your business. So that's a whole litany of things.
I think we have time for another question here. Andrew, go ahead.
I guess that's very basic. Why would founders consider these alternative paths compared to the traditional routes?
Yeah, so good question. Look, I mean, the markets are frothy and it's a lot more exciting to sell for a big number to, a financial or strategic buyer and get a whole bunch of cash up front. But the reality is if your EBITDA, which is another way of saying like your net income with add backs for any interest you're paying on debt, any amortization that you're taking on equipment, the taxes you pay, and what I would call kind of lifestyle or ownership cost to the business. If you then add all that back to net income to get to what would be called adjusted EBITDA, if that number is below $1 million, you're probably only going to sell for 2 to 4 times that number. And there are a lot of people out there that are making $300,000, $400,000, $500,000 a year in businesses that would only be valued at $4 million. Well, you can't replace $300,000, $400,000, $500,000 a year on the net after tax proceeds of $4 million. But you can create an ESOP and get maybe 2.5 million of bank financing, continue to take distributions from the business and be able to service the debt. And maybe you shield that 2.5 million from taxes entirely, and play for another sale down the road, right? Or have that your equity ownership in the business be part of a sale, right? Or maybe you just don't want to take the risk that your legacy gets handled by things you can't control. Maybe you want to protect your employees, but a strategic buyer will not guarantee that they're not going to blow out your employees. And so if you really want to protect your legacy, no matter how good the rapport is and how authentic the assurances seem in the management meetings you have and the process of talking to your potential buyers, I mean, look, the reality is, they're not going to guarantee your employees, and you can't either, right? And so, so some of these paths are just useful thought exercises, because this is, for most business owners, their biggest asset, right? I mean, this is probably the thing that's going to propel their, potential retirement or next adventure. And because of the competitiveness of the marketplace, most of the players are willing to, kind of look at these things for free, right? You can talk to an ESOP consultant without retaining them to talk about why you do an ESOP. And as part of the process of trying to get themselves retained as your consultant, they'll explain to you why you might want to sell to an ESOP. Talk to your commercial banker who, made money when you put your $5 million ABL in place, and say, do you have an ESOP specialist? Can I talk to him, right? Talk to your wealth advisor or your corporate attorney about whether they know any private equity or structured equity firms that might talk to you about what your business is worth. Go to an ACG meeting, or, talk to one of your other advisors about, meeting an investment banker to talk about what your business might be worth. Don't pay. I mean, I love lots and lots of valuation firms, and for the right purposes, they need to be used and should be used, but don't pay for a valuation on your business as a way to decide whether you should sell or not, because you're not going to get a very accurate representation. The easiest way to do that is for free, and talk to investment bankers and other transactional professionals. They'll tell you what it'll sell for, because they'll have to live with having told you what it'll sell for by structuring their fee arrangement around that number.
I'll just dovetail one more comment on why you'd explore an alternative path to just an all-out sale. Would be, maybe you're not done working. Maybe you love this business and you're not old enough, or it's just not something you want to let go of. But I've seen firsthand so many times when it's so much different to be run by an owner operator versus having, an institutional or investment capital behind you guiding you. It can change the dynamic and be a real catalyst for a company if it's done correctly. So if you still want to be there, still want to be in control in your management, that growth equity player who can be very consultative, really create efficiencies in the business or strategize around how to grow revenue, so on and so forth, can end up helping you at the end of the day create a much more valuable enterprise, and you get to still stay engaged for quite some time. So that'd be one more reason to do it.
Great point.
Well, gentlemen, thank you so much. What an interesting presentation. I want to just tell our viewers that we have also had another presentation by Kirk previously on selling your business. That's available at advicechaser.com if you want to look that up as a follow-up to this presentation. So on behalf of Advice Chaser, I want to thank you two for being here. Thank the organizations that have made this webinar possible. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners is committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and click on the link to find an advisor. Once again, from Advice Chaser, thank you so much. We will see you at another webinar soon. Goodbye, everyone.
Thanks, Marche. Thanks, Andrew.
Thank you,
Thanks,
Kirk.
everybody.
Thank you, Marche. Take care.
Thanks, everyone.